Hello everyone, welcome to our YouTube channel Making Investments Simple. And today I would be talking about mutual funds versus ULIP, and does long-term capital gains taxes on equities and mutual funds make ULIPs a better investment bet? This is a very interesting topic, and I have already created one video about the top 5 features of ULIP. You should keep also you can also watch that to get more information on ULIPs. However, here I would be talking about how these can be compared and used as an investment bet. So long-term capital gains tax are the gains arising from the transfer of the long-term capital asset, and long-term is considered as holding period of more than 1 year from the date of purchase. So this is applicable for equity mutual funds, stocks, or any other equity related schemes. So there is a lot of buzz regarding the long term capital gains post union budget 2018 in February this month, and the apparent reason is that in this union budget long term capital gains taxes were reintroduced for selling equity or equity related mutual fund units. So previously, the long term capital gains taxes, whichever the assets which you hold for more than 1 year, were tax free completely, and before the budget. And it was basically, as a little bit about the history is, these taxes were abolished in the year 2004 to promote long term investments and accelerate the participation of investors in equity markets. And it was replaced by security transaction tax, STT, way back 14 years ago. However, with the reintroduction of long-term capital gains taxes, the STT, there is no change in STT at this point of time, and that's the reason there has been many experts who have been particularly criticizing about this particular move. Now, after budget 2018, investors have to pay 10% on the long-term capital gains taxes for any kind of profits exceeding 1 lakh. All right, so that's the news. So there has been a lot of talks. You can also watch my other videos on long term and short term capital gains taxes, also about the ULIPs. So it's very common that an investor might be in a dilemma whether to continue his mutual fund investments because of this tax structure. However, you need to understand that this has been introduced this year, and this can change in future because of lot of factors, and there is a reason why this has been reintroduced. But this can change, so there is no need to panic. That's not the only reason why you should not panic. There is another good reason would be, um, any kind of capital gains till 1 lakh are tax free, just like before. Anything which exceeds 1 lakh in a financial year will be taxable as under 10%. So what you can do is, you can actually, there's one option of a workaround would be to do a systematic withdrawal plan or systematic transfer plan. So if one of the mutual funds are not performing well, you can actually do a STP, systematic transfer plan, from one fund to another. So any kind of redemption is considered as a gains withdrawal, but in this case you won't have to pay any long-term capital gains tax. Now, the let me come back to ULIPs a little bit. The reason why people can go to ULIPs is because ULIPs also work in a very similar fashion like equity mutual funds, where it is linked to equity, and it is related to markets. What can happen is, what has not changed is, the tax exemption in ULIPs or traditional insurance plans have not changed. That means any kind of ULIP investments or traditional insurance plans will still continue work in the same way, and any kind of partial withdrawals or complete withdrawals in ULIPs will are completely tax exempt. Now, please do remember that ULIPs do have a locking period of minimum 5 years, and that is the reason why people can go or not, can choose to go after ULIP or not. But um, however, in mutual funds, it's much more liquid than ULIPs. So, and yeah, I mean that liquidity factor will always remain a big drawback in ULIPs. However, again, if you are willing to invest in ULIPs for more returns, for completely tax free returns, then it's possible. So that's the reason ULIPs have can gain popularity in the coming months or coming years, if there is no change in the long term capital gains taxes structure. So yeah, so in a nutshell, with the reintroduction of long term capital gains tax on equities, ULIPs have become as more tax efficient and an alternate option for investing. So so that's, as I told you, my opinion would be that ULIPs, I mean mutual fund, equity mutual funds are still liquid than ULIPs, because ULIPs come with a locking period of 5 years, and so even an ELSS mutual fund will still hold better than a ULIP fund, because you can actually keep investing in an ELSS scheme and then start doing a systematic withdrawal plan or systematic transfer plan to another equity related schemes for better returns, and you can still be part of the ATC tax savings, as well as you can keep increasing your wealth over a period of time. So hope you enjoyed the video here. If you have any questions, do put in the comment below, and I'll be happy to answer them. All right, thank you so much, and I will see you again in my next video.